In this session, let's focus on internal loss data. What constitutes the internal loss data, which is an important constituent of the computation of the operational risk, which has been emphasized by Basel II Accord in a very heavy manner. What constitutes it? What are the key points that I really need to understand with respect to this internal loss data? How do I build an internal loss database? All these things typically go into this. Just a quick introductory kind of a session. It is very heavily emphasized as a part of the Basel II that every organization should start building its internal loss database. There are various constituents that go into it, but whatever are the internal losses that have occurred, there should be a repository of all those internal losses so that a better analysis can be done in terms of arriving at value at risk from the operational risk perspective. It's a key thing in terms of measuring and managing operational risk. And it should be completely a data on operation losses. Different kinds of operation losses, typically high frequency, low severity ones, can come purely from the internal itself. Because when we are trying to purchase this kind of a data from external vendors, this kind of a data, high frequency, low severity data, probably may not be suitable to the needs of the organization. So we need to understand that the more and more data that we are capturing on the operating losses, it is very helpful in terms of determining risk models and coming out with the estimates of losses. And it becomes a key component as a part of risk reporting and even the advanced management approach model, where we look at the frequency as well as the severity distributions and trying to find out the losses based on the frequency as well as the severity distribution model. So those kind of approaches which are more and more advanced, where we can typically look at the distributions underlying the frequency as well as the severity and try to arrive at a combined distribution of the exposure to operations risk. And just like an external data, first of all, it should be supported by a well-defined body of data standards. So that initial process has to be in place. And what is very much essential is whatever are captured or not, but the high frequency, low severity losses need to be captured quite effectively. And it should characterize more and more daily operations, different kinds of losses that are coming up as a part of the daily operations. It's more beneficial to the underlying bank than just satisfying the regulatory requirement. Okay, on one side, to meet the regulatory capital, probably a measure of this is going to help, but it is more and more beneficial to an underlying bank than simply meeting the regulatory requirement. It's a key component of the risk management framework, wherein it helps us in trying to reduce both the frequency as well as the severity of the various operational losses. Simple thing for us to understand, especially with respect to internal loss data collection, what are the key advantages? Across the firm, it increases the awareness. What all different data that we are capturing, they clearly give a kind of understanding to the employees across the firm that these are some of the key components that go as a part of the operations risk and to what extent it can have a potential harm to the firm. It helps very much in quantifying the exposure to risk completely. What in case the loss is going to occur, how much, in case the risk is going to occur, how much is the loss the company can typically get into. So once I know that this is the quantity of loss, It really helps in terms of coming out with mitigation plans. It comes in terms of how can I typically reduce this kind of risk. And at the same time, when I see that this is the number, what is causing it? What has caused this particular kind of a loss? So we can do a kind of causal analysis on that, and a control mechanism can come out, which can improve the overall process and try to bring the process under within the limits. And it's one more way of improving. On a self-assessment mode, we can evaluate the process of the organization. We can do a self-assessment of the process of the organization, because the actual loss events are typically used as a quality check over the self-assessment. But what is the operational loss event? There should be an amount of clarity on that. And just a couple of more points with respect to operation loss. Only the direct losses need to be recorded. Direct losses can come all the way from writing down of the assets, any kind of loss of the physical assets. Any of these numbers can typically come up. These effects are objective. They can be measured, they should be measured directly and consistently. And whatever the losses that we are measuring, they should facilitate the measurement of the operation risk, which can play a role in terms of the working out on the regulatory capital. Even if some kind of data which is qualitative also, or which is more softer, which cannot be quantifiable, probably in some cases it is worth for me to collect that kind of a data, at least for doing some kind of qualitative analysis. And typically a few more data that needs to be captured, which is not identified as a part of the Basel. Any near misses, not loss, but would have resulted in a loss. Any such kind of stuff, especially failure. Some failure occurred, but no financial loss, no indirect loss, but it was a failure. It is kind of a lesson to improve. Or in some more cases, another better way to talk about it is, there was a failure in some other organization which is a close competitor to us. It did not occur to us, but it has occurred to them. Even these kind, whatever such kind of losses have come out, understanding these kind of data is also very essential. Right? Any kind of business interruptions that have come out, any income that got foregone, means we were not able to collect the income, which is also a kind of a loss. Reputation loss, though financially it is not a direct loss, but some such kind of indirect losses. Any kind of business interruptions occurred, any kind of income that is foregone, poor quality kind of a feedback from the customer, all these things need to be, though it did not result in a financial loss straightforward, but even that kind of a data needs to be captured. Even the strategic as well as the business risk related events need to be captured. But here comes the most important point. How do I decide this loss threshold? Which means decide some kind of cutoff. If the loss is below that, not capture. Any loss that is above it, try capturing it. You have to capture it. So deciding this number is a very critical part. In some cases, probably the loss could be only $10, but the cost that I would incur to typically capture it could be $20. So always look at it from that perspective, because every capturing of the loss is a matter of cost versus the benefit. So if the cost is much higher than the benefit, better ignore it. And how much should be the cost? Yes, different kinds of risk, different kinds of activities for different kinds of firms. This number keeps changing. But yes, for each of these things, there should be a kind of a loss threshold that needs to be defined and typically being used for all kinds of decision taking purposes. And at the same time, try to understand that whatever the threshold that we are setting, it should include the data collection process. It should make it manageable, cost effective. It should not be like the threshold that I have defined will make my data collection process more and more costly. As it progresses, it looks as if the cost is more than the benefit that I'm going to derive out of it. So it should be more and more depending on the business line, the event type, the different kinds of activities. All these things should come into picture. But yes, threshold definition is one important aspect of the internal data which is not captured as a part which is not a requirement of Basel, but it is definitely going to improve the operations risk management process internally. And just to understand a few more interesting properties of the internal loss data, it is very relevant when it is linked to the current business activities, technology, risk management. So there should be a linkage between the loss data and the strategic activities, the business activities, technological advancement. There should be a clear-cut relationship. A minimum 5 years of internal loss data should be used, especially if I am computing the operation risk for calculating regulatory capital. Don't depend on 1 year's or 2 years kind of loss data, because there could be some losses which are low frequency, high severity in nature, which may or may not have occurred in the last 1 year. And along with that, there could be a few losses which there could be a completely drastic change in the pattern of the losses in the last few years. So we have to observe the short run as well as the long run kind of losses. So a minimum of 5 years time frame is what is typically makes the assessment of the operational risk and the capital setting for the operational risk more and more effective. And whenever we are talking about a very solid procedures with respect to internal data collection, look at these things. Whatever the loss data that you are collecting, it should be more and more comprehensive. It's not an abstract data, very detailed loss data is what we are collecting. We have documented the objective criteria for allocating the losses to each of the specified business lines and event types. And information, whatever we are collecting, it's just not the gross loss amount. It could contain various other elements like the type of loss, the nature of loss, and the situation of the loss, and how much can be recovered, the recovery rate, lot of other aspects which are associated with that loss. And there should be a clear-cut criteria that must be defined for assigning the loss data, especially if there is a centralized risk management function or centralized loss assessment. And operational risk losses, especially relating where there is an involvement of the credit risk, treat it as a part of the credit risk. But any operational risk losses that are related to the market risk, they should be treated as a part of operational risk. This is a very important statement. Any operational risk losses which involve some kind of credit risk, categorize it as a part of the credit risk, but any of these operational loss data related to market risk, put it as a part of operational risk losses only. So a decent understanding of internal loss data, what constitutes it, how should be captured, what has to be captured, is something, a quick overview as a part of this session. Alright.